The point and figure chart, by its unique method of construction, provides a clear visual representation of this cause being built and a method for measuring its potential. Before we continue, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this video to more people and tells me these deep dives are worth making. The law of cause and effect is the theoretical foundation upon which Wyckoff's point and figure method rests. The principle is simple yet profound. The length of time a stock spends moving sideways within a trading range, and the volume of shares traded during that time, builds the cause for the subsequent move. A long period of accumulation, where the composite man is quietly absorbing shares, builds the cause for a significant and sustained uptrend. Conversely, a long period of distribution, where the composite man is feeding stock into the market at a top, builds the cause for a significant downtrend. While a vertical line chart, which plots price against time, shows the duration and volume of this preparation, the point and figure chart isolates the price action into a format that makes the cause measurable. The horizontal dimension of a point and figure chart represents the extent of the cause. Each column of X's or O's within a consolidation area is a unit of measurement. The wider the horizontal formation, the greater the cause, and therefore the greater the potential effect, which will be expressed as a vertical price move. Wyckoff discovered that by simply counting the number of columns in a horizontal point and figure formation, he could derive a reasonably accurate projection of the minimum price move to be expected once the stock breaks out of that formation. This transformed the process of setting price targets from a subjective guess into a logical, evidence-based calculation. It allowed the trader to assess whether a potential trade offered a reward that was at least 3 times the risk, a core tenet of his methodology. To properly apply Wyckoff's counting method, one must first understand how to construct the charts exactly as he did. His method differs from many modern interpretations, and its specific rules are essential for accurate analysis. He primarily used 2 types of charts in combination: the 1-point chart for detailed, short-term analysis, and the 3-point chart for a broader perspective on the more significant trends. Let us first examine the construction of the 1-point chart. This chart takes no account of time or volume. It is a pure representation of price movement. It records the movement of a stock from one full figure to the next, such as from 35 to 36, or from 35 down to 34. All fractional movements are disregarded. The chart is plotted on cross-section paper. An upward movement is plotted using X's, and a downward movement is plotted using O's, or, for simplicity in our examples, with numbers. To begin a plot, you start with the current price. For example, if a stock is at 50, you place a 50 in a square. The price then moves to 52. You would enter 51 in the square above the 50 and 52 in the square above the 51, all in the same vertical column. You continue plotting in the same vertical column as long as the price moves in the same direction. A change of column only occurs when the price reverses by a predetermined amount. For a standard 1-point chart, that reversal is 1 full point. So if the stock, after reaching 52, declines to 51, you must move 1 column to the right and begin plotting downward starting with 51. If it then continues down to 45, you would fill in the figures 50, 49, 48, 47, 46, and 45 in this new column. If the stock then rallies back to 49, you would move 1 more column to the right and begin plotting upward again with 46, 47, 48, and 49. It is critical to note that if a price level is skipped in the actual trading, for instance, if the stock jumps from 50 to 53 with no trades in between, you must still fill in the squares for 51 and 52 on your chart as if trades had occurred there. This ensures the integrity of the horizontal count. To keep track of the passage of time, Wyckoff recommended placing the initial of each new month below the column where it begins, and circling the final entry of the previous month. While the 1-point chart is excellent for detailed analysis, it can be sensitive to minor, insignificant fluctuations. To gain a clearer perspective of the larger trend and the more significant causes being built, Wyckoff used a 3-point chart. The purpose of the three-point chart is to condense the history recorded on the one-point chart by discarding all reversals of less than 3 full points. This filtering process provides a much clearer view of the major campaigns of accumulation and distribution. The construction of a three-point chart is derived directly from the one-point chart. For example, if a stock on a one-point chart moves from 25 up to 31, then reacts by only 1 point to 30 before continuing up to 32, this one-point reaction is ignored on the three-point chart. The three-point chart would simply show a single uninterrupted vertical column of X's from 25 all the way to 32. Similarly, if the stock had reacted by 2 points, say from 31 down to 29 before moving to 32, this 2-point reversal would also be disregarded. A change of column on the three-point chart only occurs when the stock experiences a reversal of 3 full points or more. For example, if after reaching 32 the stock then declines to 29, this 3-point reversal would necessitate a move to the next column on the right, and you would begin plotting the downward move from 31. This method of filtering reveals the larger, more meaningful swings, and creates the broad horizontal formations that are essential for projecting major price objectives. Wyckoff also noted that for very high-priced or extremely volatile stocks, a 5-point chart could be used, following the same principle. He strongly advocated using the 1-point and 3-point charts in combination, as one provides the fine details for timing, and the other provides the broad perspective for strategic planning. With a clear understanding of how the charts are built, we can now delve into the core of the method, the horizontal counting technique. This is the practical application of the law of cause and effect. The horizontal formations or congestion areas that appear on the point and figure chart represent the cause being built. It is in these areas that the stock is either being accumulated for a future rise or distributed for a future decline. The width of this formation, measured by the number of columns it occupies, indicates the potential extent of the subsequent move. The technique itself is straightforward. First, you identify a well-defined trading range or consolidation area on your point and figure chart. Then you count the number of columns within that area along a specific price line. This count represents the force of the cause. For an upside projection from an accumulation area, the count is typically taken along the price line of the lowest point of support within the range. For a downside projection from a distribution area, the count is taken along the price line of the highest point of resistance. Once you have this count, you project the price objective. For a one-point chart, the number of columns in the count is added to the low of the trading range to find the upside target, or subtracted from the high of the range to find the downside target. For a three-point chart, the process is the same, but the column count is first multiplied by 3. This multiplication factor accounts for the greater significance of each column on the condensed chart. Let us walk through the hypothetical stock campaign Wyckoff used in his course to illustrate this method in action. Imagine a stock that has been declining and begins to form a base in a range between 30 and 35. On the one-point chart, after several swings, a clear line of support forms at the 30 price level. As the stock continues to trade sideways, this line of 30s widens. Let us say that the count of columns along the 30 line reaches a total of 12, including any blank spaces within the formation. This count of 12 represents the measured cause. To find the upside objective, we add this count of 12 points to the price level at which the count was made, which is 30. This gives us an initial price objective of 42. Now we turn to the three-point chart for confirmation and for a longer-term perspective. Because the three-point chart filters out minor reversals, the horizontal formation may look different, but it will represent the same underlying cause. Let us say that on the three-point chart, the line of support at the 30 level has a width of 7 columns. According to the method, we first multiply this count by the chart's unit value, so 7 times 3 equals 21. This result of 21 points is then added to the support line of 30, giving us a longer-term upside objective of 51. The Wyckoff analyst now has two correlated projections. He has a short-term objective of 42 and a longer-term objective of 51. This tells him that the accumulation taking place in the 30 to 35 range is significant and is preparing the stock for a substantial advance. He can now plan his campaign with these targets in mind, entering a position at a logical point, such as a spring or a jump across the creek, with the confidence that the potential reward is far greater than his initial risk. As the stock begins its markup phase, he can track its progress against these projected targets, using them as a guide for when to expect resistance or when the move may be nearing its culmination. This methodical, evidence-based approach to setting price objectives is what separates the Wyckoff method from mere guesswork. It provides a logical framework for understanding a market move from its inception in the cause to its completion in the effect. Having established the foundational principles and mechanical construction of the Wyckoff point and figure chart, we now proceed to its practical application. Theory without proof of practice is of little value. The true power of this method is revealed not in hypothetical examples, but in its application to the crucible of the real market. Richard Wyckoff did not merely theorize, he tested and refined his methods over decades of active trading and analysis. He left behind a rich record of these analyses in his educational courses, demonstrating step-by-step how the point and figure counting method could be used to project the price objectives of real stocks in real market campaigns. In this section, we will conduct a series of deep dive case studies, examining the very charts that Wyckoff used to teach his students. We will walk through these historical campaigns, applying the counting technique to see how it provided a clear and logical roadmap for the significant market moves of his time. This is the practical work of a Wyckoff analyst, translating the horizontal cause into a vertical objective. Our first case study is an exhaustive analysis of a campaign in Bethlehem steel, covering the period from late 1930 to mid-1931, as detailed in Wyckoff's course. This example is particularly instructive as it showcases the method's utility in both bull and bear swings and demonstrates how one phase logically leads to the next. We begin in November 1930 with the stock in the midst of a severe decline. On the one-point chart, the price falls precipitously from 71 to 59. After such a steep drop, an oversold condition is created, and the stock begins to form a horizontal congestion area. This is the first point at which the analyst must begin to pay close attention. The stock rallies from its low near 59, but fails to recover more than half of its decline, being turned back at a price of 66. It is here that the first significant cause begins to build. The price moves sideways, forming a distinct line of distribution across the 65 and 66 levels. On the one-point chart, this horizontal line stretches to a count of 11 columns. This count of 11, taken from the 65 price line, gives a downside projection to a price of 54. However, the three-point chart provides a broader and more ominous perspective. It filters out the minor rallies and shows a more consolidated area of supply. The count across the 66 level on the three-point chart is 8 columns. Multiplying this by 3 gives a projected decline of 24 points, indicating a downside objective of 42. As the price breaks down from this distribution top, it fulfills its initial one-point projection by slumping to the mid-50s. After a brief pause, the decline resumes, and the stock eventually reaches the low 50s. It is at this point, around the 50 level in late December, that the character of the market begins to change. A new and far more extensive horizontal formation begins to take shape. For nearly 2 months, the stock oscillates in a range primarily between 50 and 55. This is the new area of study. Is this a pause before a further decline, or is it a major accumulation base? The answer lies in a careful analysis of the point and figure chart. A long and broad base of support is established along the 50-point line. Wyckoff's analysis showed that by counting all the columns from the beginning of this formation to its end in early February, the total count on the one-point chart was an impressive 25 columns. This massive cause, built over many weeks, projected a powerful effect. Adding the 25-point count to the low of the trading range gives an upside objective between 72 and 75. The 3-point chart confirmed this conclusion. The count across the 50 line on the 3-point chart was 8 columns. Multiplying this by 3 gives a 24-point projected advance, indicating a target of 74 to 75. With this clear upside objective, the Wyckoff analyst would have been on alert for a buying opportunity, such as a spring or a jump across the creek, to enter a long position. The stock then began its markup phase, moving steadily higher throughout February. As it approached its price objective in early March, reaching a high of 70, the character of the P and F chart once again began to change. A new wide horizontal formation appeared, this time as a sign of distribution. A line of supply formed across the 69-point level, stretching for 8 columns on the 1-point chart. This signaled that the advance was over and a new decline was imminent, with a projected target of 61. The stock subsequently broke down, precisely as projected, fulfilling the forecast. This Bethlehem Steel campaign is a classic example of the Wyckoff cycle in action, and it demonstrates the remarkable power of the point and figure count to project the price objectives for each successive phase of the cycle. Our second case study examines the action of U.S. Steel in 1931, another detailed example from Wyckoff's course. This case is particularly useful for demonstrating how to analyze a major distribution top. In February 1931, following a significant rally, U.S. Steel began to build a large horizontal formation with a resistance line around the 152 level and a support line around 143. For over a month, the stock traded within this range. The Wyckoff analyst, tasked with projecting the next move, would turn to the point and figure chart to measure the cause being built. The count on the 1-point chart across the 149 to 150 resistance level was a substantial 23 columns. Subtracting this from the high of the range gave a downside objective of approximately 126 to 129. This was a clear warning that the next significant move was likely to be downward. However, as with the previous example, the 3-point chart provided an even more powerful and accurate forecast. The consolidated formation on the 3-point chart across the 148 level yielded a count of 12 columns. Multiplying this count by 3 gives a projected decline of 36 points. Subtracting this from the top of the range indicated a much lower price objective, around 112 to 116. This showed that the distribution was significant enough to cause not just a minor reaction, but a major decline. Following this period of preparation, the stock broke support in March and began a relentless downward march. The decline did not stop at the 1-point objective, but continued steadily lower. As the weeks passed, it became clear that the larger projection from the 3-point chart was the more accurate forecast. The stock did not find any significant support until it had reached the 110 level in May, fulfilling the 3-point projection with remarkable precision. This case study underscores 2 important points. First, it demonstrates the superior value of the 3-point chart for gauging the potential of major market swings. Second, it shows how the point and figure count can provide a clear warning of a major decline long before the public, which is often still bullish at the top, becomes aware of the danger. Our final and most powerful case study is Wyckoff's analysis of the 1929 market top, one of the most famous and accurate forecasts of his career. He demonstrated how the point and figure chart of the New York Times 50 stock average gave a clear, quantifiable warning of the impending crash. Throughout the summer of 1929, while the public was consumed by an unprecedented level of speculative frenzy, the market averages were building a massive horizontal cause. The NY Times average moved sideways in a broad range, with a major support level forming around the 296 to 300 level. Wyckoff, applying his counting method to this vast formation, found the evidence to be overwhelmingly bearish. The count on the 3-point figure chart taken across the 299 price line was an enormous 44 columns wide. When multiplied by the 3-point factor, This yielded a staggering projected decline of 132 points. Subtracting this from the 299 level at which the count was taken gave a downside price objective of 167. This was a scientific projection based on the measured cause, indicating that a decline of catastrophic proportions was the most probable outcome. When the market broke its support levels in October, the subsequent panic unfolded with a violence that shocked the world. But it did not surprise the students of the Wyckoff method. The market, after topping out at 311, plunged relentlessly downward. The initial panic culminated in November with the average hitting a low of 165. Wyckoff's projection of 167, made weeks before the crash began, was proven to be accurate to within just 2 points. This legendary forecast stands as a timeless testament to the power of the point and figure method when used correctly. It proves that major market events are not random acts of fate, but are the logical effects of causes that can be seen, measured, and projected by the astute analyst who knows where to look and what to measure. It is essential, however, to heed Wyckoff's own cautionary advice regarding this method. He repeatedly warned his students that the point and figure count should never be used as an infallible or mechanical system. The price objectives derived from a horizontal count are not certainties. They are probable targets. The market may fall short of its objective, or it may overshoot it. The count provides a logical destination, but the analyst must constantly judge the market's action on its journey toward that destination. Wyckoff insisted that the point and figure chart must always be used in conjunction with a vertical line chart. The vertical chart, with its record of price and volume, provides the critical moment-to-moment details about the character of the market. It is the vertical chart that confirms the trend, shows the quality of supply and demand, and reveals the buying and selling climaxes that often mark turning points. The point and figure chart tells you how far a stock might go. The vertical chart tells you how it is traveling on that path and whether it is likely to get there. To use the point and figure chart alone, without reference to volume and the detailed price action on the vertical chart, is to ignore half of the available evidence. The Wyckoff method is a holistic approach, a synthesis of multiple tools, all designed to interpret the market's own story. For those who wish to truly master the lessons discussed here, it is essential to study them from the source. Please take note of a unique new edition of Richard Wyckoff's masterpiece, How I Trade and Invest in Stocks and Bonds, by Max Davidson. It has been meticulously adapted for the modern trader, complete with explanations that make Wyckoff's timeless wisdom more accessible than ever. For anyone who wants to truly absorb the lessons we are discussing, this adapted edition is an indispensable part of your library. The link to this book is located in the description of this video. In conclusion, the Wyckoff point and figure method for setting price objectives is a unique and powerful tool that stands apart from nearly all other forms of technical analysis. It is the direct practical application of the market's most reliable principle, the law of cause and effect. By teaching the analyst how to measure the cause, the extent of the accumulation or distribution in a trading range, it provides a logical and evidence-based means of projecting the extent of the subsequent effect, the uptrend or downtrend. It is not a simple pattern to be memorized, but a profound technique for quantifying market potential. When used with judgment in combination with a careful reading of price action and volume, it transforms trend trading from a simple exercise of following the price into a strategic campaign with defined, measurable objectives. It is a cornerstone of the scientific approach to the market that Richard Wyckoff championed throughout his life.